Guys, buying a house on a low income can feel overwhelming to say the least. And honestly, in some cases, it's even more challenging. Depending on your situation, a lender might hesitate to approve you for a mortgage, and a lower income can make it harder to save for a down payment and your closing costs. But here's the part that most people don't tell you. A low income does not automatically mean that you're locked out of home ownership. With the right approach, the right loan programs, and a bit of strategy, buying a home can still be very achievable. But guys, before we talk about how, in case you're new around here, my name's Nima and welcome to the channel. I'm a corporate executive with over 15 years of experience in both sales and finance. My videos break down complex financial concepts to help you on your financial journey, whether you're just starting out or if you're already a seasoned pro. So guys, let's jump into today's topic, which is, can you buy a house with low income? So let's begin. Now, a lot of people ask, can you actually buy a house with low income? And the answer is simply yes. There are loan programs and assistance options out there that exist specifically for this reason. The key is understanding how your lenders look at your financial picture and knowing where you can improve it before you ever apply. One of the first things that lenders look at is your credit score. Your credit score helps determine whether you'll get approved and what kind of interest rate you even qualify for. Even if your income isn't high necessarily, a strong credit score can work heavily in your favor. That's why it's so important to check your credit score ahead of time through Equifax, Experian, or TransUnion. Even if you see errors on your report, make sure you dispute them. That alone can sometimes raise your score faster than people actually expect. And here's something that isn't talked about enough. Credit card balances matter more than people realize. Even if you're making payments on time, using too much of that available credit can actually drag your score down. Simply paying a card down 30% of the limit, or even better, under 10%, can actually bump your score in a matter of weeks, not months. Another big factor lenders care about is your debt to income ratio, also known as DTI. This is basically how much of your monthly income goes towards your debt. There are two versions of this, but the main idea is simple. The less of your income that's tied up in your monthly payments, the better you look to the lender. Ideally, lenders like to see that your housing costs take up no more than about 28% of your income, and that all of your debts combined stay around 36%. That said, these aren't hard rules. Some loan programs will allow higher ratios, especially if the rest of your profile is strong. Now, here's a little insider tip coming from me. Paying off a small monthly debt can sometimes help you more than paying down a large balance. Removing a $50 or even $100 monthly payment can entirely improve your DTI faster than chipping away at a big loan. Once your credit and your debt look reasonable, the next step is figuring out what you can realistically afford. This is where a lot of people actually get tripped up. Your mortgage payment isn't just the loan itself. You also need to factor in the property taxes, the homeowner's insurance, the mortgage insurance if it's required, and possibly HOA fees on top of that. Now, of course, there are everyday costs as well, like utilities, maintenance, and repairs. They don't show up on your mortgage statement, but they absolutely affect whether a home fits your budget. If you don't already track your spending, looking at your recent bank statements can give you a surprisingly clear picture of what you can actually handle month to month. Now, before I jump into the topic of down payments, if you're gaining value from this video, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Your support helps this channel grow, so please show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's talk about the down payment because that's where a lot of people get discouraged. The idea that you need 20% down is actually outdated. There are plenty of loans that allow 3 or 3.5% down, and some require maybe even no down payment at all. You'll also need to plan for closing costs, which usually falls somewhere between 2 and 5% of the loan amount. What many buyers don't realize is that in some cases, sellers can help cover those costs through credits. That can dramatically reduce how much cash you need upfront, something especially helpful if your income is limited. But before you even start house hunting, it's a good idea to talk to multiple lenders. Different lenders have different guidelines, especially when it comes to government-backed loans. A loan officer can review your situation, tell you what you qualify for, and point out exactly what you'd need to improve if you're not quite there yet. That way, you're not just simply guessing. Another thing that can quietly help low-income buyers is understanding how lenders view stability, not just income size. Lenders care a lot about whether your income is consistent, even if it's modest. Someone earning less but with steady employment for 2 or more years can sometimes look stronger on paper than someone making more but job hopping or freelancing without a clear track record. This is especially important if you work hourly, have multiple part-time jobs, or earn on commissions. Documenting consistent deposits and keeping gaps in employment to a minimum can make a bigger difference than people actually realize. Guys, it's also worth noting that your location plays a bigger role than most buyers would expect. Many assistance programs are tied to specific cities, counties, or even individual neighborhoods, and some are only available if you buy within certain income-targeted areas. In some cases, simply buying a home a few miles away can unlock thousands of dollars in grants or down payment assistance. This is why working with a lender or housing counselor who understands local programs can be a huge advantage. A small shift in location or timing can completely change what you qualify for. If your income alone still isn't enough, another option is applying with a cosigner. This is usually a family member or someone who you trust who has stronger income or credit. Just understand that a cosigner is equally responsible for the loan, so this only works if both sides are completely comfortable with that arrangement. Choosing the right loan program can make a massive difference. FHA loans are popular for a reason, and they allow lower credit scores and smaller down payments. VA loans are incredible for those who qualify, offering zero down and no mortgage insurance. USDA loans also allow zero down and are available in many areas people don't realize that they qualify, including some suburbs. And there are also some programs like Good Neighbor Next Door, which offers major discounts for teachers, firefighters, law enforcement, and EMTs, as well as Home Ready, Home Possible, and state housing finance agency plans that offer low down payments and assistance with upfront costs. Finally, guys, don't overlook local and state assistance programs as well. Many offer grants or even forgivable loans for down payments and closing costs. And if you're a Section 8 voucher holder, some housing authorities allow you to use that voucher towards your home ownership instead of rent. The bottom line is this: there isn't a specific income number that determines whether you can buy a house. What matters is how your income fits into the bigger picture, your credit, your debt, your loan type, and your strategy. Low income doesn't mean no options. It just means that you need to find better information and a smarter approach. Guys, I want to thank you for watching this video all the way through. If you found it helpful, please go ahead and smash that like button, leave a comment down below, and subscribe. I make new videos like this every single week, so stay tuned for more to come soon.